Good day, everybody. Welcome to today's live market update. My name is John Pasalis. My team and I help buyers and sellers throughout the Toronto area make smarter real estate decisions. If you'd like to meet up with me and my team, you can just click the link in the show notes below or send me an email at askjohn@movesmartly.com. But of course, these sessions are also a live Q&A. So if you have questions, please post them in the chat. Urmi Desai from Move Smartly, our co-host, is keeping an eye on those. We're going to go over your questions as they come up. And for those who are kind of new to our show here, the goal, of course, is to give everybody an insight into what is going on in the markets today, what is happening, sort of what has happened over the past month, what are the statistics tell us, but also what we're seeing on the ground in terms of the trends. So this month, we're going to be talking, I'm going to touch on a little bit on a video I did recently on why the housing market hit the brakes. We're going to look at the stats for housing condos. I'm going to bring on Gus and Davin from our office to talk about some of the trends they're seeing on the ground, some of the things they're hearing from their own clients. And as always, we're going to bring on David Larock, mortgage broker, contributor to Move Smartly, integrated mortgage planners, who's going to be talking about interest rates with us and some of the things going on there. Now, before we kind of do all of that, just a quick preview on interest rates. A lot has changed. I'm going to set this up for Mr. Larock. Over the past week and a half or so, a lot of the dialogue before that was all about rates falling. And what's happening right now, it looks like, at least in the near term, fixed rates are going up. 5-year mortgage rates in Canada are based on the 5-year Government of Canada bond yield. And this chart shows us what that yield has looked like over the past week, and it has shot up. So again, these are short-term dynamics, but they could end up being longer-term depending on how things play out economically. David's going to walk us through some of the things that are leading this surge in bond yields and what is effectively going to be a slight potential increase in fixed mortgage rates. So again, it's fascinating how for the past while we're talking about rates falling, but again, the bond market's not controlled by the Bank of Canada. It's controlled by the market. It's driven by bond traders. And for a number of reasons, the yields on bonds have been going up, even though the markets were expecting rates to kind of cool. But David Larock is going to be walking us through all of those dynamics. Before I kind of walk through the trends in the housing market, I wanted to touch on briefly a video I kind of unpacked over the past week or two on why Toronto's housing market hit the brakes. I want to mention this again because after I recorded this video, a couple of things kind of jumped out. I started thinking about that I did not talk about in the video, and I think they're important to think about. Now, for this video, I kind of unpacked why the market cooled down. And if we look at how the market was sort of, 6 months ago, it was unbelievably competitive. It was very busy, multiple offers on houses and condos. And literally in 6 months, the market kind of did a 180 and inventory piled up. I mean, houses had about 2 months of inventory. We're in the 4s now. Condos had, I think, 3 months of inventory. We're pushing 7 months of inventory. So the market really cooled. So to understand why this happened, I really just wanted to look at how sales and new listings volumes have changed over the past 8-9 months. And to do that, what I did was I looked at the number of sales and new listings each month and compared that to the 10-year average. And again, the idea here is to see what sales and new listings volumes look like compared to historical norms, but more importantly, how those differences have evolved over the first 8 months of the year. And maybe this can help us understand what is going on in the housing market. So I'm going to look at some data. Sort of this next chart, I'll kind of describe what we're looking at, basically shows each month's sales and new listings volumes relative to the 10-year average, which means that if the measure is 0%, it means sales or new listings are equal to the 10-year average. If it's down 20%, it means we're 20% below the 10-year average. And what has happened is at the start of the year, sales were about 12% below the 10-year average. So, somewhat soft, but not insanely soft. But on top of that, new listings were also close, like 17% below the 10-year average. So new listings were also very soft. And this continued over the first sort of 2, 3 months of the year. By March, new listings were 26, 27% below their 10-year average. So we had very, very soft listing volumes. Even though sales were soft, new listing volumes were also quite weak. But what has happened since the first quarter is sales plummeted. So by the time we hit March and for the rest of the year up into August, sort of this analysis goes to August, sales volumes are basically 30-35% below their 10-year average. Now, what has happened to new listings is actually the exact opposite. New listings accelerated, and by the past through June, July, August, we were very close to the 10-year average, with new listings volumes in July actually exceeding the 10-year average. So we have sales that are 30-35% below average, listings volumes that are kind of typical for the time of year. So you have what happens, basically inventory starts building up. Now, the one thing I wanted to mention is certainly sales volumes are low. I talked about in my previous video, because people are hitting pause on their search. People can't afford today's price at today's rates. They're waiting for rates to fall, all sorts of things. I did not give an explanation for why listings have been increasing. And there are a couple of reasons. I mean, number one is new listings volumes were quite weak in 2023. And certainly probably what is happening is some people who are just waiting for the market to recover are just running out of time and just deciding to list and just kind of tired of waiting. But more importantly, one important thing to think about, what made me think about this was actually I was speaking at a conference, and one of the speakers there was hosted by a company called Veritas. And one of their investment researchers who looks into banks, Nigel D'Souza, brought up an important point that most of us know about, but you just sometimes, I mean, it didn't cross my mind to think about it, but it's actually very relevant. And his point, and what he's talking about, is that a lot of people are looking at the number of power of sales and the number of people defaulting on mortgages as a measure of distress. But the reality is, in Canada, and especially in a market like the Toronto area, you don't get a ton of people defaulting because most people have a lot of equity in their homes, right? So what happens is, if you are under financial stress, and your home is, worth $300,000 more than your mortgage, you have equity in that home. You're not just going to walk away and default on your mortgage and have your bank take over your property. What happens in those situations more often than not, when people cannot afford their payments and, may default, is actually they end up just listing their homes for sale and moving out on their own terms. This is basically this self-curing process where homeowners effectively manage sort of their, basically mitigate the risk of default by selling and moving on, downsizing, or doing whatever they're doing. So, and the point here is that it's very possible, and we don't know for sure, part of this increase in new listings could be driven by that factor. So we're not seeing defaults, but it's very possible we're seeing more households who are distressed, who just needs to sell and move on to deleverage because they cannot afford, their current mortgage payments. So that's one thing I wanted to unpack, is I think it's an important thing to think about. And of course, this is all, I'm just speculating. We don't know because we don't have data on this. At the end of the day, these households have not defaulted. They're not necessarily, they might be behind, but we don't have data on how many people are moving out for these reasons. But certainly anecdotally, we hear a little bit more about financial stress in households and people needing to deleverage and move on. So when we think about the market over the next 6 to 12 months, I think the listings volume is certainly one of the things that we need to be keeping an eye on. And certain things like this, like people deleveraging, could be one factor. The other one I actually just thought about, because I had a conversation about it a little while ago, is that we could, so the city of Toronto has increased the vacant home tax in the city of Toronto from 1% to 3% next year. And I mean, just last week, I got a phone call for someone who had a pied-à-terre in Toronto who basically said, I need to sell this thing because I'm not paying 3% vacant home tax on this property. To avoid it, you have to be living in the home for at least 6 months of the year. They're not. So it's very possible we might see a few more people list their homes for sale in the new year to avoid the vacant home tax. So we'll have to keep an eye on how all of these things play out. Quickly, I'm going to take a quick look at the monthly stats just at a high level. So first, we're going to be looking at low-rise houses. I'm going to be comparing detached home sales compared to their 25-year average. So we're looking at what things were like in October or September, rather, relative to every previous September. And if we look at the number of sales, they're effectively at a 25 or 30-year low. So, I mean, coincidentally, the past 2 years have also been very weak. So 2022 and 23 are very similar to 2024. But those 3 years combined are basically the lowest volumes in 20 years. I mean, I think the next lowest was in 2001. So we have very, very soft sales volumes, which goes back to kind of how I kind of started this previous section on why the market is cooling down. Effectively 20-year plus low in sales volumes. And when we look at new listings volumes came in just over 8,000, which is roughly in line with historical trends. Again, some months in the past or some years have been a little bit higher, some a little bit lower. But generally largely in line with historical norms. And when we look at the number of active listings at around 11,000, that again is relatively typical. Active listings, we have to keep in mind, is a function of sales. So in very hot markets like, 2021, active listings are very low because demand is so strong. People are just buying whatever's on the market. In slower markets, we have an increase in active listings. Now, if we think about the months of inventory, which measures the balance between supply and demand, how many active listings divided by the number of sales, low-rise homes are about 4.5 months of inventory now. And low-rise home prices are still just over 1.3 million, down about 1 to 2% year over year, but have largely been moving sideways since the second half of 2022. So for about 2 years, we've had, this sort of flat prices. We saw a bit of an acceleration in the first quarter of 2023, but things have kind of leveled off. So we've been pretty flat. And in fact, we're no further ahead than we were at the start of 2021. So we're effectively probably gonna be about 3 years now, where prices are flat. And obviously we had the rapid run up in 2020, end of 2021, beginning of 2022, but we're effectively back to where we were in early 2021. When we look at the condo market, when we look at sales, very similar dynamics. We're effectively not quite, about a 15-ish year low. So again, the 2022, 2023, and 2024 were among the slowest years for the condo market for the month of September. 2012 was very similar, but we're approaching 20-year low in sales volumes for condominiums. Again, much similar trends, interest rates weighing on the market, and very few people wanting to buy investment condos. When we look at new listings, on the other hand, new listings are the second highest they've ever been. The only other period where they were higher was September 2020. This was driven sort of at the peak of COVID, like COVID just, obviously kind of kicked in maybe 6 months earlier. And what happened is a lot of people left the cities. Condos were going empty, rents were falling and plummeting. So a lot of people just decided to move on and sell their units. And that's why we had a huge spike in condo listings in 2020. But things are, again, second highest new listings volume for condominiums, about 5,200 or so for the month of September. When we look at active listings, on the other hand, active listings for condo apartments in Toronto in September hit about 9,000. So this is just condo apartments, doesn't include condo townhomes, is the highest they've ever been. And overall, the listings, and I've been talking about this on our show, the number of condos overall available for sale is basically at the highest level for any month in any given year. So this is, of course, comparing September of last month compared to the previous Septembers, but we're really at the highest volume of listings kind of basically ever. the months of inventory for condominiums is hit 6.6 months. This is a very soft market. Again, a reminder that as months of inventory increases, it's the market cooling down. The volume of listings coming on the market is growing faster than the people buying them. So your inventory just keeps piling up. And this effectively is what is happening in the condo market today. Again, it is a very relatively high volume of active listings, so the condo market, it remains quite sluggish. The city of Toronto has the softest, I should say the softest market, but the highest months of inventory at about 7 months of inventory. So it's a very, very slow market. And then average prices, again, much like houses, have been pretty flat, just under 700,000 in the high sixes. But they're down about 5% this year over year, and that's a couple of months in a row that we've seen that. So we're definitely seeing a little bit of softening in some areas for condo prices. And again, part of this is just fueled by there's just so much inventory on the market that, you know, it's effectively a buyer's market today. Now, I'm going to wrap up before I bring on Gus and Davin to look at one thing I look at, which is sort of months of inventory weekly. And I look at that, of course, partly because when the market is volatile and tough to predict and things swing wildly from from bullish to busy to slow, as we've seen over the past 6 months, we want to measure these to see which way the market is going. And interestingly enough, when we do that, the trends over the past couple of weeks show that months of inventories actually has been trending down. So I don't know if this is a long-term trend. I don't, and part of this is sales definitely have picked up over the past couple of weeks. I don't know if this is just buyers rushing in and wanting to get ahead of the market. Maybe they think prices will be higher in the new year. It's very difficult to say. But again, part of this is, again, we're seeing fewer listings and more buyers, more sales relative to listings. So months of inventory is trending down. So I think it'll be important to see how this evolves over the next 2 or 3 weeks, because this is largely what influences the future path of home prices and condo prices. If months of inventory continues to decline over the next 4 months, it's again a combination of either more owners just taking their condos off the market or homes off the market and not selling, perhaps hoping that the market is going to be better in the new year, or more buyers getting into the market, maybe trying to get ahead of what they think might be a busier new year. But of course, how things will evolve between now and January is anyone's guess, especially, and as Dave's going to walk us through, with the volatility we're seeing in the economy and sort of geopolitical issues that are going on and how those are playing into interest rates. So with all that said, I'm going to actually stop sharing my screen. We're going to bring on Gus and Davin from our team to walk through a little bit about some of the things they're seeing on the ground. And in particular, some of the things they've heard from their clients. The federal government is increasing the cap on insured mortgages from 1 million to 1.5 million. They're increasing the maximum amortization for first-time buyers with insured mortgages from 25 to 30 years. What have they heard from their own clients, regarding these policy changes, and what are some of the things they're seeing on the ground? Gus, Davin, welcome again. Thanks for joining the show.
Hello.
Maybe Gus, we'll start with you. What are some of the things that you've been seeing over the past month or so?
Yeah, it's been slow, obviously. I mean, we keep saying that. It's been pretty quiet. There has been a new batch of buyers, I guess, that's come into the market in September. So we've seen some activity, but overall, compared to other Septembers or even early Octobers, it's sluggish. One interesting thing that I've seen is that, I mean, in the beginning of the year, I had a lot of upsizers or downsizers. These are people who own a home and are looking to, buy a larger home or get into a smaller home. And that activity kind of disappeared in 21 and most of 22 for obvious reasons, COVID and high rates. And it came back. It came back considerably in the beginning of the year, and now it's kind of it seemed to really stall I'm not saying people are not upsizing or downsizing, but there's a lot less people doing it. I'm hearing concerns of people who specifically they would rather buy first and then sell their home. So they're concerned. They're concerned. What if we don't get? What if we can't sell our home? What if we can't get the money that we want for our home? What if we buy and then we're in trouble? And it's a kind of funny time because we're going into November, December holidays. December usually slows down. So even if you buy now in late October,
Hi,
you don't want to be
can you
listing.
please do a
I think we got a crossover.
Yeah, it's fine.
There we go. Thank you. And you don't want to be listing your home in December, right? So we're seeing a bit of a holding pattern there, but there's still lots of people asking questions and interested. In terms of the new rules, yeah, I've heard from a couple kind of first-time home buyers are excited about it. They haven't started their search just yet, but I do think it's going to help some people definitely enter the market that maybe have a smaller down payment, and that'll be interesting how it plays out into the new year.
Yeah, and it's helpful to unpack kind of what you touched on, because I think it's an important one. It's definitely something I've been hearing quite a bit more of. I probably have talked about on our show. I can't remember if I was on the news, I mentioned it, but certainly the slowing market is impacting sales. Like, there is this sort of feedback process because, again, typically in Toronto, most people who buy a home and need to upsize usually buy first and not sell their current home. But as the market cools down and people start to see more for sale signs on their street sitting there for a month and far fewer sold signs, people start to worry. People, and rightfully so, they're worried. Well, what if I buy a home and I go to sell my home and I can't get the price I want, or it doesn't sell, right? And that's the thing in a slow market. And people aren't used to this in Toronto. It's not even always about price. Like, well-priced homes may only get 6 showings a week right now, right? So there is a lot of uncertainty, and people are rightfully concerned about buying first and then selling in today's market. And I think it's this moving target. So I think it is important to keep that in mind. And I think the challenge is we have clients who are thinking, well, the market's great now. It's a buyer's market. I want to take advantage. I think you can get a deal on the home I want to buy. But then, of course, they have to sell, and they're also selling in what is, potentially a buyer's market. So it is a very tricky thing to navigate. And I think, we're probably, it's definitely, I'm seeing more people wanting to buy first to sort of mitigate that, or sorry, to sell first to mitigate that risk. So
Yeah, I think
good
the other
point.
thing is that I was just going to say to add to that, I think the other reason it's sluggish because even if I was a first time home buyer, I'd be kind of pausing and waiting right now, let the rules come into play, right? Because those rules don't go into play until later this year. So that's and I know a couple of those, so they're watching, they're doing their homework, but nobody's less people are diving in at this moment. So.
Yeah, and before we bring on Davin, I mean, the rules are important for a lot of people, of course. Even extending the 30-year amortization effectively, I mean, Dave will correct my math, I think it basically increases the average home buyer's budget by 9% or 10% or something like that. And again, I mean, that assumes that they're increasing their amount of debt while keeping their payment constant, as if it had a 25-year AM, and that's kind of what the longer amortizations allow for. So some people, especially in very expensive markets, they're using the longer amortization not to lower their payments, but to actually increase how much they can spend, because it's such a unaffordable market. People kind of needs to use that as a way to get in. So certainly, I think some buyers are waiting till January. Davin, what are some of the things that you've been kind of seeing on the ground?
I just want to add to your points there. Like, it's hard to have it kind of both ways for buyers and sellers, right? It's kind of damned if you do, damned if you don't for buying and selling, and experiencing some of that right now with folks. The first time home buyer, like Gus said, it's kind of like the spot where you not want to be, because obviously prices are high, but it's more of a straight line transaction. But I do have people who are concerned about maybe prices in 2025. We're like, will they go up? And we're just really no one really knows.
Mhm.
Like you said, it is sort of a buyer's market, and I'm seeing, a couple houses that one would expect to have sold for upwards of 100K more that are selling now for, less.
Yeah.
And these are not dumpy homes. These are nice first-time home buying homes. And they do land in that kind of 1.1, 2, 3 category, which, is now unlocked for certain people. Mind you, it's a large debt load because you are using much less down payment. But, if they can manage the payments, then there they are. So that's what I, kind of think on that. And for myself, yeah, it's like Gus was saying, it feels more like summer months right now, where we're kind of like, some people are just kind of spinning tires, kicking tires, not being terribly active, and that's, it's twofold, that there's just not much to look at, and there's the anxiety in the market, depending on where you're looking, right? I've had condo buyers who've, all but kind of, disappeared. It's a holding pattern. It's a wait and see. The condos that are decent and well priced, yeah, they're still moving, but holy cow, there's a lot of inventory out there. It's almost overwhelming, where you don't want to buy something because you just, your thinking is, geez, there's so much for sale. How could prices not fall? And
Okay.
why aren't they just plummeting? And the people who own the assets are the gatekeepers, right?
Mhm.
It's their prerogative to sell. And I find that in the freehold space too. If people want to do, a move up buy, well, they're gate kept, if you will, by the people who are in that $2 million home, because they want to move up from their 1.5. And it just kind of goes down the line to where there's just not a lot to look at for first time home buyers. So I'm not sure what's gonna, break the levy, because we don't want the price levy to break. Like that would be a little crazy, but yeah, slow sales for
I mean,
sure.
some people want the price levy to break, let's be honest. I mean,
No,
some
I mean
people
break. I mean break on the way up. Like,
oh yeah, you're
yeah,
right. 100. Yeah.
right? Because it's expensive. It's expensive. We want them to, yeah. We don't want them to, fly crazily again. I feel like people are pulling the purse strings a little bit because they know what took place.
You mentioned a couple things I think are worth unpacking. I mean, number one, you kind of talked about prices in some areas down like 100 grand, and you're 100% correct, right? And I think it's, when we talk on the show or on the news about average prices is one thing. I mean, it is an average. It does not mean that is what's going on in every area. And some areas have more inventory than others. Some areas you've seen comparable sales, several that are way below what we would have expected. So you're 100% correct. I mean, around our office, I see prices where I'm like, holy shoot,
Yeah.
that home that just sold for 135 would have sold for like 145 or 147 6 months ago, when like it was impossible to buy anything and everything was like getting multiples. So definitely, and I think if you're a buyer, you have to be very cautious when you're looking at comparables, because if your agent's pulling up comparables from 6 7 months ago, they're going to tell a very different story from the most recent comparable. So I do think and I think it's regional. It's very neighborhood specific. So that was one interesting thing you said. The other thing about being a first-time buyer, 100% correct. A lot of homeowners are more comfortable with first-time buyers buying their home because they don't have anything to sell.
That
Like
too. Yeah.
I had clients. I mean, I'm going to tell the story because they were a great client who, like, I basically helped them buy a home conditionally on selling their home, which never happens in Toronto. So, and when we were selling their home, they were very anxious about selling to someone who's upsizing effectively, because their thinking was, well, what if they can't sell their home? It's going to screw up their whole process. And they were prepared to take significantly less from a first-time buyer than from an upsizer, because they just felt that there was more certainty. So yeah, sometimes first-time buyers, can feel out the sellers or what the seller's concerns are, and sometimes they'll, the sellers will say that, or their agent will say that, and they
And
have some.
might I add, good on the listing agent for doing that bit of due diligence, finding out who has a home to sell or not. If
Yeah,
you
yeah,
didn't do that, that would have been information you wouldn't have had. So kudos
yeah.
to you.
I mean,
Kudos.
yeah. I mean, we always do that. You want to know because,
Not
I
everyone
mean,
does. Not everyone
yeah.
does.
And yeah, to Davin's point, I mean, why do we do that? Because when my clients selling their home, not only do we have 3 offers or 4 offers, I can't even remember. Not only do you want to know if the buyers have a property to sell, we need to know what kind of property, right? Because
And
if there
where?
are two buyers that are very similar, or three buyers that are very similar, the same price, I mean, the best is the one with has not anything to sell. The second best is the one who has a starter low-rise home, you know, in the same area, because that's going to sell a lot faster than a condo. You know, someone who needs to sell their condo to close on the home that they're buying is like a no-go. Like I probably would even tell my clients, don't even bother accepting it, because it's a disaster. Like the condo market is so slow that there's a high probability that they're just not going to sell their unit. So yeah, you have to do that due diligence in this market, because otherwise your client's holding the bag if the buyer kind of defaults and doesn't close.
Yep.
So, you
You
know,
also mentioned that interesting
huh?
thing. Sorry, I was just going to say, you mentioned an interesting thing about looking at comparables, and I
Yeah.
think that's really important right now. Like I sold a property recently in Wexford, and the agent was quoting me comparables from like 8 months ago, because there wasn't a lot of sales.
Mm.
And I'm like, 8 months ago, the market was totally it was totally different, right? So you got to really take your time. Even when our clients are buying, I'm always worried about, is my CMAs, the comparables, are they the right comparables? Is the price that I'm advising on value okay, or are we overpaying here because the market's on a downturn? Always conscious of that, and not everybody always is. And then on the flip side, when I'm selling a place, I'm always thinking, well, we're in a mindset of defense, and kind of just the market's sluggish and there's not a lot out there. But hold on a second, like I had a property in Leslieville that was a condo recently with my colleague Peter, and yeah, market's horrible for condos, but this was such a unique condo.
Nice.
Floor plan wise, it was only other 10, the Colgate property. There was only other 10 other units of the same floor plan within that building. And the view it had, and the finishes that it had. And so, yeah, a year ago we probably could have got 750 for it, or sorry, maybe 2 years ago we could have gotten 750 for it when the condo market was on fire. But we priced it low enough that it was still attractive, but not too low, because it was a condo. Because we understood that there was only 6 or 7 other units in for sale in Leslieville, and we were the best one. So we priced it, a little bit higher, and we got it. We got it 10 grand below, right? So
And you guys sold like a
That
week,
unit was
didn't
one of
you?
those.
yeah, it sold in a week. We did really well. When we had multiple, we had 2 offers. But yeah, even the agent that bought it was like, she's been waiting for a unique one like this. All the other ones are like cookie cutter, straight box. So it goes to show, right? You got to really take your time, whether you're on the buy side or the sell side, to really understand the neighborhood and the product, like you mentioned.
Yeah, and those
So,
are
I
those
mean,
few that are selling, right?
was
That I was
that?
talking about. Those few that sell. You can tell within like 4 or 5 photos,
Yeah.
be like, this condo's going to sell, and that was that one. And then the rest are all they're just hanging out.
So for your Wexford property, the agent who called you and is bringing up comps from 8 months ago, I'm gonna guess that that's worked in your favor, and you kept silent and didn't say anything about those
Yeah.
comps. But
Yeah, exactly. Well, there was a couple plays. It was that transaction that I sold, and yes, that helped us a little bit. And there was an agent across the street also selling a house, and he thought he was worth way more than he was, because he was a selling agent of a house competing with ours. And I had a conversation with him before we listed, and he's like mentioning things from months ago that sold, even a year ago, that sold probably 80 grand more. And I'm thinking to myself, I didn't tell him anything because he's the listing agent of the other house. But I'm scratching my head like, buddy, you're not going to get that number. And he did it. They came to their senses and sold for a lot less.
That's so funny. Urmi, do we have any questions before we kind of bring David on to chat about the wild world of interest rates?
I think a lot of the questions relate to that wild world.
All right.
It's kind of turning into a question of rates versus actual prices needing to come down. So maybe we'll hold that discussion to after David's comments.
Okay, beautiful. Awesome. Guys, Gus, Davin, thank you again for jumping on.
Thank you.
We'll see you next month.
Okay.
And Mr. Larock, Is he with us? Hello, David. How are you?
Hey, John, how are you?
Fantastic. Thank you again for joining us. And I'm not sure if you saw, I kind of kicked off today's show by having a teaser slide about what has happened to bond yields in 1 week. And it's fascinating that I think talking about bond yields will keep people on and excited, but it should, because it is so important when we think about what is happening in the market, what is happening in the economy, and what is happening to interest rates. So maybe can you maybe first unpack first thing before we even talk about what has happened to bond yields, maybe for everybody, why 5-year Government of Canada bond yields matter to the average home buyer. Maybe let's just start there, and then we'll talk about kind of what has happened to them.
Sure. Well, everybody knows there's fixed and variable rates, and they are moved by different forces. If you have a variable rate, the only time your variable rate will move is when the bank changes their prime rate. And that happens when the BOC moves their policy rate. So long story short, the BOC's policy rate is currently at 4.25. Lender prime rates are at 6.45. So if the Bank of Canada announces a cut, its next meeting is October 23rd. It is expected to cut. So let's say the BOC says we're cutting by 0.25%, 0.25 or 25 basis points. Their policy rate goes from 4.25 down to 4, and the lender prime rates go from 6.45 down to 6.2. So if you have a variable rate of prime minus 1, today your rate is 5.45. The BOC cuts on October 23rd. On October the 24th, your rate of 5.45 goes down to 5.2%. That's if you're a variable rate borrower. If you're a fixed rate borrower, your fixed mortgage rates are priced off of Government of Canada bond yields. Those are basically the benchmark yield that determines how fixed rates are priced. So the benchmark Government of Canada 5-year bond yield is determined by thousands of investors buying and selling each day based on their view of the future, on what they think is going to happen. So today, if a very good variable rate is priced at prime minus 1 at 5.45, you can get a 5-year fixed rate for under 4.5. So the reason that is, John, is that the bond market sees the expectation that the Bank of Canada is going to cut rates. Right now, they're pricing in 1.25% worth of cuts by the summer of next year, and they reflect that in bond yields. So in other words, variable rates only move when the BOC actually does something, but because Government of Canada bond yields are forward-looking, they move in anticipation of what the BOC will do. And that's why every time you get a new jobs report or inflation report or something comes out that moves the market, which we'll get to in a second, that reflects bond yields and impacts fixed rates. So the classic call I have with borrowers who have fixed rates locked in with me, but their deal hasn't closed yet, is they read a headline that says, oh, the BOC cut by 0.25%. Is my fixed rate going down now by 0.25%? And I have to explain to them, no, when the BOC cuts, it only affects variable rates directly. Fixed rates are priced on bond yields, which already expected that cut, and bond yields haven't changed today. And if they Google the Government of Canada 5-year bond yield, they can see that I'm telling the truth, that that's in fact the case, that yields moved ahead of them. A lot of times in the market, you buy the rumor and you sell the fact. So because the bond yields move in anticipation of a cut, when the cut actually happens, the market expected it, it's in the price. Now, if the BOC, when it does that cut, uses extra dovish language, so they sound more concerned about the economy going forward than they used to sound, or they allude to the fact that maybe there'll be more cuts in the future than the market expects, or less cuts, that can move bond yields, but that's new information. If the BOC does what the market thinks it's going to do, no change in yields.
Okay, that's super helpful. So as I mentioned, last month, we were in this period where, we were expecting, of course, the Bank of Canada to drop their rates, but also fixed rates to gradually dip over time. I mean, this was the expectation. And all of a sudden, in the past week, it looks like they may be trending up again. So can you kind of unpack what has happened in the economy and what might be driving this potentially increase or likely an increase in fixed rates, at least in the near term?
Yeah, well, fixed rates have already increased, so
Okay.
it's already happened. But here's the long and short. A couple of weeks ago, the wind was at our backs as far as mortgage rates goes. The Bank of Canada Stats Canada had just confirmed that inflation had returned all the way down to the bank's 2% target.
Mm-hmm.
The Bank of Canada's policy rate's at 4.25, but its neutral level, basically the Bank of Canada raises rates when it needs to slow inflation. And raising rates increases borrowing costs and acts as a brake on economic momentum. And for as long as the policy rate is above the range of 2.5% to 3%, the BOC's policy rate is putting brakes on the economy.
Mm-hmm.
Well, when the inflation returns to 2% target, the economy doesn't need any more brakes.
Mm-hmm.
Right? The economy basically is now, we're going to see a little bit of an uptick in the next few months because there's something called base effects, and oil prices are going up, which I'll get to in a second. But we hit a 2% target, and the bond market looked at that and said, well, if the Bank of Canada doesn't need to be restricting momentum in the economy to bring inflation down anymore, then its policy rate shouldn't be 4.25. It should be down to 3 or 2.5 pretty quick. And that's what was reflected in bond yields.
Mm-hmm.
And then the U.S. Federal Reserve came out, and because U.S. Treasuries pull Government of Canada bond yields in the same direction. So, for example, in Canada, if we get a really lousy jobs report that suggests the BOC should be cutting rates by more, but the U.S. gets a terrific jobs report in the same week, our bond yields go up. They should go down as investors price in a more dovish Bank of Canada and a lower Bank of Canada policy rate. But because we trade so much with the U.S. economy and we depend on a lot of U.S. imports for our basic needs, when U.S. Treasuries go in the other direction, Government of Canada bond yields get pulled along for the ride, regardless of what our domestic economy says they should be doing. So, long story short, when the U.S. Federal Reserve it enacted its first rate cut, and it cut by 0.5%.
Mm-hmm.
And the market really liked that because it basically looked like, okay, now the Fed's in cut mode. That's going to open up the door for the BOC to cut more quickly, because when the BOC was cutting and the Fed wasn't, the loonie was really weakening against the greenback. That was inflationary because it was raising the cost of all our imports. So as soon as the Fed started cutting by 0.5%, that was a really positive signal as far as reinforcing the belief that rates were going to go lower and that lower yields were justified. So Stats Canada confirms we've hit target. BOC is really dovish the last time it cuts rates, and the Fed cuts by 0.5%. Oh, and by the way, mortgage rule changes, extended hands for everybody. I mean, what a week we had.
Yeah.
But then, as is often the case, there's an old rule by a guy named Bob Farrell, who has his 10 rules of investing. Whenever the markets expect one thing is going to happen, something else happens. And it only took a week. A week later, two really significant things happened. First of all, the price of oil went up 10%. The geopolitical conflicts in the Middle East finally caused the price of oil to increase, and a 10% hike in the price of a barrel of WTI in a week is a huge move. And oil prices and labor costs are basically the two things that really drive the direction of inflation going forward. Because if you think about oil prices, they're an energy cost and a transportation cost, but they're also an input cost to all of the plastics that we make. So when the price of oil goes up, it has a really pervasive impact on costs throughout the economy, and it's quite inflationary. So over the course of last week, oil went up by 10%. And then on Friday, the U.S. employment report came out, and the U.S. economy is estimated to have generated 250,000 new jobs last month. It was expected to have generated 150,000. And the previous 2 months estimates for U.S. job growth were revised up by 72,000. The combination of those two factors caused U.S. Treasury yields to take off. The benchmark 10-year U.S. Treasury yield went up by 30 basis points, which is 0.3%. Not surprisingly, the Government of Canada bond yield went up by about the same amount, and lenders increased their fixed rates because the Government of Canada bond yield, the 5-year GOC bond yield, is what our 5-year fixed rates are priced on, and they've gone up as a result. So, and by the way, the reason that the U.S. employment thing really moved the U.S. Treasuries market, by association, the Government of Canada bond yields, is the Fed has a dual mandate. The BOC only has to keep inflation stable. The Fed has to keep inflation stable and promote growth and a healthy job market. When it cut by 0.5%, the Fed said, we know the economy's not slowing by that much and inflation still needs to come down. We're only at 2.5%, 2.4% as of today, but back then it was 2.5%. But we're worried about a weakening employment backdrop. So this 0.5% cut is a preemptive move to try to bolster the employment market against any further weakness. Well, when you get a banner jobs report a week later, that narrative goes away. The bond market is then saying, well, wait a second, if we thought the Fed was going to keep cutting going forward to protect jobs, and jobs don't need protecting because we just found out the employment report came in way higher than expected, then yields need to be higher. And when they moved up, they pulled GOC bond yields higher. So really, John, it was a story of two things. 10% increase in the price of oil and an upside surprise on the U.S. employment report. I don't think longer term this changes anything about the future. I think we're in a generally falling rate environment. I think this is a blip. And ultimately, I don't think this moves things. It certainly doesn't shift my view going forward. I'm prepared to change my view if the factors change, but this is, in my opinion, something that'll probably work itself out in a couple of more weeks. We just got the U.S. employment report today. Overall inflation fell from 2.5 to 2.4. The market was hoping for 2.3, so it didn't fall by quite as much as the market had hoped, but it still fell. And overall, the market tends to shoot first and ask questions later. So I'm not surprised the reaction on Friday was that U.S. Treasury yields went up because the market was nervous with oil prices rising and the banner employment report. But that stuff kind of sorts itself out in the weeks that follow. And my assessment right now is that we can still expect rates to fall, although clearly we're in a short-term blip up for now for those reasons.
Awesome, David. Before I jump in and ask Urmi to join us to ask some of the questions, just to kind of summarize for the average person kind of what you just, so the bond yields and so the fixed rates are trending up for two reasons. Number one, higher energy prices put a higher risk on inflation, which means there's potentially less incentive for the Bank of Canada or the Federal Reserve to cut as aggressively, potentially, if that happens. And then a booming jobs market also puts a less incentive on the Federal Reserve to basically cut rates as aggressively, right? It's like kind of like the combination of both. So, it's interesting how, of course, sensitive rates are to sort of all of these economic data points that are coming out every month and every couple of weeks. And of course, like you said, yes, longer term, we're probably in a lower rate environment, but we're still have these, geopolitical risks that could kind of throw a bit of a curveball. So it's tough to say. It's super interesting. So thank you so much for unpacking that. I'm going to bring Urmi on because I think she said we had some questions for you or for me about the economy and rates and all of this stuff. So
hi, Dave and John. Yes. First of all, let's just go straight forward. Some questions for Dave, and then I think a bit of a more detailed discussion. So from Misha, do Canadian politics affect the bond market? Dave, you mentioned everything, but
yeah, I wouldn't say to a significant degree, like policy changes. I think that stuff, if the Bank of Canada thinks that policy changes are going to significantly change the trajectory of Canadian real estate and they're concerned about it, then could they change the rate at which they're cutting rates or reevaluate their strategy? Sure, they could. But I don't think the bond yield move we saw in GOC bond yields had anything to do with the mortgage rule changes. I think we were pulled along by rising U.S. Treasuries and by higher oil prices. So long story short, there's probably some small impact, but not a significant one. And I don't think it was the reason why yields are up and fixed rates are rising right now.
All right. Thanks, Dave. And now, kind of a two-parter. Several of our viewers are asking. So Fran Kong asks, with the high listing numbers on the condo market and very low buying rate, does it indicate a landslide on condo prices in coming months? And then Rick, is sort of related to this, asks, if normal fixed-term mortgages settle in the high threes for the longer term, won't the whole pre-construction condo paradigm have to shift? It makes no sense for investors to buy at those rates. So I think both of these questions are getting at this issue of how long can these prices hold?
John?
I mean, it looks like investors are, some are cutting a little bit. Many are hanging on. I think many are expecting the market to be busier in January. They're expecting lower rates, and again, the federal government's mortgage changes to stimulate demand. I don't think that necessarily means prices are going to skyrocket, but I think some people, if they can get sort of what was market prices 4 months ago, rather than dropping 4 or 5%, they'd rather do that. So. But again, a lot of this depends on, again, how much more inventory piles up. If inventory starts to drop because investors would just rather rent their unit and wait till January, again, this takes pressure off of the downward momentum. Do you know what I mean? Because investors are saying, or condo owners are saying, you know what? I don't want to sell this price. I'm just going to take it off the market. So it's hard to predict again, and we're talking about how many people rush to sell and how many are motivated and how many need to drop their price, and we don't know that yet. So certainly there are risks, but we'll have to see how they play out.
And again, from Carl, a related question. We need home prices to drop quite a bit before we buy. High interest rates are here to stay. Condo maintenance fees have to fall before we consider buying a condo. The condo sizes are too small. 3-bedroom condo size minimum with maintenance fees too high. So again, a question. It seems like everybody's saying, what is, this stalemate?
Listen, I think, and I think I didn't answer the other question about Rick about pre-construction, and 100% pre-construction's like largely going to be non-existent for quite a while. Like I don't see people buying pre-construction condos at the price that developers are charging, given what is going on in the environments today, given what's going on with condo prices, given what's going on with condo rents. It's not happening. They're not going to be selling those. And quite frankly, I think more investors are actually looking to get out of being condo investors because it's expensive, especially if you bought recently, you're cash flow negative, it's difficult to sell them. Landlord tenant laws are a bit challenging. So yeah, that's going to be an issue. With respect to prices, listen, I think it is a challenging markets to buy. I mean, Dave will be able to tell you as well. I think a lot of what has happened over the past 5-10 years is like our market's just being pushed up by capital more than income growth, right? And by that, I mean, people are just finding more money, either saving it or getting it from families to afford a house today, right? So, on the one hand, yes, it is elevated. Do prices needs to crash? I mean, they might, but I don't necessarily think that being elevated means prices will crash. Again, most people, this isn't like the US housing bubble where people getting mortgages with no income and no jobs, right? Most people are getting mortgages from big banks. And I mean, Dave, you correct me if I'm wrong. Most people are coming with bigger down payments today than they did 10 years ago. Like even as a percentage of the sale price, forget the dollar amount, obviously that is up, but relative to what they're purchasing, I mean, it's the only way to buy a home. So I don't know how the market evolves, but I don't know if it necessarily means that prices have to crash back to 6 times household income from 10 today. I don't think that's going to happen. But
yeah, John, I would add to a point you made earlier, lower rates take the pressure off the other factors, right? If affordability is a problem, and it is, then one of 3 things have to happen. Prices need to come down, rates need to come down, or incomes need to rise. So right now we've got average wages rising at about 5%. Mortgage rates have fallen significantly. They peaked at 6%. They're down to 4% now. That's a 20% increase in affordability for the average borrower. And prices are off 15% from their peaks. Average prices using the CREA stat for all of Canada, and average real estate prices aren't really informative because we're all dealing in regional markets. But if prices are falling, rates are dropping, and incomes are rising, all of those things are tailwinds for affordability. But clearly more needs to happen, and we're not there yet.
All right. I think you lead us very nicely to our last, I'll call it the $1 million crystal ball question from Connie Tong. For both of you, in this type of economic conditions, as rates continue to fall, that's a question mark, shall we expect a stronger seller market for freehold homes to sell our own home early next year?
I mean, Dave, what do you think? I mean, I've commented on this on our show. I mean, My instinct is yes. I don't know. Like again, I don't know if we're going back to crazy like 20 offers on homes. But do I think do I think homes will be selling more quickly? My instinct is yes. Do I think we're gonna have more total buyers in the market, more showings? I think yes. I think it's, and again, obviously, this largely depends on broader economic conditions, geopolitical risks, or whatever. But if we do follow this, declining rate environment and rates are in the threes, I would think we're going to start to see definitely more demand for low-rise homes. I don't know, Dave, what do you think?
It certainly can't help, John, or sorry, can't hurt. But interestingly, everybody kind of assumes when rates fall, prices will go up. And it's understandable. In 2008, the last two times rates fell by a lot were 2008 and COVID. In 2008, we had a US housing crisis. Our rates dropped because, like I said before, the GOC bond yields are tied to US Treasuries. US Treasuries fell through the floor, pulled down GOC bond yields. So Canadian mortgage rates dropped by a lot, but we didn't have a crisis in 2008. Our economy did well. Our house prices went up. Rates went down. House prices went up. During COVID, rates were slashed because our policymakers were trying to avoid a Great Depression. Again, rates fell through the floor and our economy was fine. It was like the shortest recession on record. In reality, we ended up coming out of it a lot stronger temporarily. So again, rates went down, prices went up. Fast forward to today, circumstances are different. This time we do have economic slowness, more slowness than is evident in the US right now. So just because rates are falling now and prices went up the last two times it happened to a material degree is no guarantee that that will be the case now, because the factors underpinning that fall in rates are different. We have domestic economic weakness this time. We didn't have it the last two times rates dropped by a lot. And that means that the response we got out of house prices the last two times isn't guaranteed this time. And again, I don't think it certainly can't hurt to have lower rates. But I don't think if I were looking to sell my house, a lot of people are assuming if they wait for rates to drop, they'll get a better price on their house. Because rates are dropping because of weakness in our economy, I'm not convinced that that's a good assumption to be making. And there are probably a lot of other sellers with the same plan. And if everybody's waiting till next spring, then next spring there'll be a lot more sellers than buyers, and that won't be good for prices. So careful with that assumption.
You actually touched on a couple of important points, and I need to be cautious of this because even though I think the market will be busier, I think a lot of people interpret that as you're going to get 10% more for your home if you wait till January. And that's not what I'm saying. I think that's what people are hoping for, right? But I don't think that's happening. And I agree with you. I think like it may be busier. Your home just might sell faster. And be sitting on the market for 4 weeks or 5 weeks, right? So I do think we'll see more demand, but you actually also raise another important consideration that could also obviously impact the market a lot, which is if we're seeing a lot more listings hit the market, right? Both because people holding off and waiting for the new year, they think it's going to be better, but also as I touched on, and I don't know if we were here at the beginning of the show, but I touched on what when we were at the same dinner, Nigel D'Souza talked about how in Canada, a lot of people don't default on the mortgage. They just sell their home when they can't afford it. So you have this sort of self-curing process. And one of the reasons I suggested at the start of the show that new listings volumes have elevated back to historical norms over the past few months might be because of this distress. People just can't carry their mortgages. And I hear it anecdotally. People call me and they're like, I can't afford this. I bought this investment property. I bought that investment property. I'm bleeding cash. I cannot afford these payments. So definitely we may see more of that in the new year. So it's not just about will demand be higher, because I think probably lower rates with the federal government's mortgage changes, demand will be a little higher. But the market conditions are also a function of what is happening with homeowners and sellers and investors and all of those things. Like I said, if we see, I would not be surprised, people start to realize they're paying 3% on a vacant home tax. A lot of people who have pied-à-terres in Toronto are going to be selling them because no one wants to pay 3% on a vacant home tax. So it's so hard to predict, but yeah, I think we'll see the market demand should be a little bit busier, but again, listings are going to be impossible to predict. Awesome. So thank you, Urmi. Thank you, everyone, for your questions. Thank you, David, for joining us again this month. As always, everyone, if you have any questions, you can reach out to David Larock personally. If you have any mortgage questions, you can reach out to me at AskJohn@MoveSmartly. And as always, Urmi's going to include a link to my latest monthly report, which I unpack some of the things that we talked about today in a little bit more detail. And as always, we'll see you next month.